attendees to come in. Thank you very much for joining us this afternoon. We appreciate you taking the time out of your busy schedules. We're very excited to offer this program today. Thank you very much to Brian and Brendan for joining us from Whittlesey. The topic today is don't overlook your potential refund from the Employee Retention Tax Credit. We were just discussing this earlier. This is a great option for many of our employers, just a little hard to navigate sometimes. And so we've got a great team here to lead you through a discussion to really showcase how you can take advantage of this very important program. I would like to really thank Margie Craig from Whittlesey for her assistance in putting this together. But without further ado, I'm going to send this over to Brian to introduce himself, and then Brendan will kick us off after. Thank you again for joining us. If you have any questions, please use the question and answer function at the bottom or the chat, and we'll get to those at the end. Thank you again. Over to you, Brian.
Thank you, Joanna. Thank you for having us today, and hello to everyone who's on the presentation. I'm an advisory partner with Whittlesey, which in the past year has meant a lot of PPP and a lot of ERTC. So we've been really at the forefront with helping clients kind of identify these additional ways to kind of buttress their cash flow during an otherwise difficult time. So Brian Kerrigan, I'm an advisory partner from Whittlesey. I'll turn it over to Brendan.
Thank you, Brian. My name is Brendan Healy. I'm a tax partner with Whittlesey. And in our tax practice, we focus on a number of things like tax strategies for business owners, tax incentives for business owners, state and local tax, not only compliance, but also incentives. So this, as we're going to get into, this is a wonderful incentive. And we often refer to it as kind of a sleeper kind of a thing, because it's just really, it doesn't seem like our clients have gotten the same traction on this as PPP, for instance, or other type incentives. So this is a great incentive. And we hope you learn something today as we go through these slides. So having said that, can we get started on the slides? That's great. So today we're gonna go over the ERC, the Employee Retention Tax Credit. It is a payroll tax credit. It's not an income tax credit. And it is also a refundable credit, which we'll talk about later on in the slide. So this is it's an important incentive, and we'll kind of walk you through why this can be very valuable for your business. The eligibility rules are a little different, where this credit is a new credit, new being it was born in 2020 as a result of the pandemic, and the 2020 tax rules, which you as a business owner may be able to still qualify for. The 2020 rules are different than the 2021 rules. The 2021 rules are actually more favorable for the business owner. So we'll walk you through those. We'll walk you through those rules as well. There's a concept that I think Brian will get into more detail about a full or partial shutdown. Really, the whole purpose behind this credit is to help employers keep people employed, to provide some additional cash for the business, etc. And we're going to talk about kind of the eligibility for this. Some of which is you look at your revenues, and if you have a certain amount of decline in revenues, you can be eligible for this. But there's other ways to be eligible for this. So it's important that we walk through the rules and you understand the ways you can claim this credit. We'll talk about the wages that do qualify for this, although in kind of the small business world, most, if not all, the wages will qualify. We also want to talk about this tax credit versus the PPP loans that many business owners are familiar with, and I'll go into that and kind of the interplay, which is a little bit important. And then we'll talk about how to claim this credit. Again, this is a payroll tax credit. It's not an income tax credit, so you claim this credit with your payroll tax filings. And then we'll get into more details. So next slide, please. So very quick history. This credit was created in I believe at the end of March of 2020 as a result of the pandemic, and the credit was designed to give employers some additional resources, some cash, to help keep folks employed. However, when it was first introduced, what the law said was you can either go after a PPP loan or you can go after this credit, but you can't do both. You've got to choose which one is better. And I would say in my client base, 9.5 out of 10 clients all went for the PPP loan versus thinking about this credit. And that was likely a good idea at the time. So the old rules said you can only take one or the other. You can't have both. Then later on in 2020, right at the end of 2020, the Congress changed the rules as well, and said, well, gee, you can claim if you went after and got a PPP loan, you can also now claim this credit. So they opened it up. They removed that restriction, number one. And number two, they enhanced or they expanded the credit into 2021. So round one was a credit only available for the tax year 2020. But then at the end of 2020, the Taxpayer Certainty and Disaster Relief Act opened this credit up for the first 2 quarters of 2021, Q1 and Q2. And there's also an election to use an alternative quarter. We'll get into that later on in the slides. But the third law change, which was important, was March of this year, the American Rescue Plan Act, where it took this credit and instead of the first 2 quarters of 2021, you can now claim this credit for all 4 quarters of 2021. And that's very important, and it really grows the value of this credit as we'll get into the calculations. So next slide, please. So and as we're talking about this, it's important to keep in mind the 2020 rules versus the 2021 rules. And as I've learned about this, I've kept notes because it gets a little confusing. But in general, the credit for 2020, the credit is it's an annual credit. So you get 1 credit for the entire 2020 year. 2021 is different. You get it each quarter. You can claim the credit each quarter. But talking about 2020 right now, we get 1 credit for the entire year. And that credit, if we qualify for it, that credit is equal to 50% of a maximum of $10,000 of wages per employee. Said a different way, the maximum amount I can get for the credit in 2020 is $5,000 per employee, as long as I qualify, and as long as I paid that employee at least $10,000 during the year. If I have part-time employees or whatever, and I paid them less, then the calculation is 50% of those wages. But in general, it's 50% times the wages paid to the employee during the year. And if you do the math, that's a nice incentive. But as we roll into the 2021 rules, it just gets even better, because the credit is not only 50%, but it goes up to 70%. So we still have the $10,000 wages that I paid my employee on a quarterly basis, not an annual basis, but a quarterly basis. And it's 70% times those wages. So it's a maximum of $7,000 per employee per quarter. So you can imagine, you can get a $28,000 credit from the IRS per employee for all of 2021 if we qualify for each quarter, and you look at it on a quarterly basis. So again, it's just an amazing credit. We'll walk you through the calculations, but just so folks understand, it's a wonderful incentive that we're trying to get people educated about. Okay, next slide. So some of the other rule changes as they kind of morphed and changed this credit, it opened it up to public colleges, universities, public healthcare entities. For 2021, as I mentioned, the employee wages increased from $10,000 annually in 2020 to $10,000 per quarter in 2021. It's a 70% credit versus a 50% credit. We can still claim the 2020 credit, but it's just the calculation is lower. We'll get less dollars in theory, but we want to claim as much as we can. We're gonna talk about the decline in gross receipts, because in order to claim the credit, we have to qualify for the credit. And there's generally a couple tests you look at. One is a reduction in gross receipts. And for 2020, if you're taking notes, here's where you want to take some notes. For 2020, you look at any quarter in tax year 2020. So Q1, 2, 3, 4, and you look at the 2020 quarter, you look at gross receipts for the 2020 quarter as compared to the 2019 quarter. So you're looking at year over year, well, I should say quarter over quarter. You're comparing gross receipts from 2019 to 2020, and you're looking for either a reduction of at least 50% of gross receipts as compared to 19. So 19 versus 20, a 50% decline in gross receipts. And if I hit that test, that 50% threshold in any one of the quarters, then I can qualify for this credit in 2020. The important note is for 2021, we still have that test, but it's only a 20% reduction in revenue. So for those business owners that know this, 50% decline in gross receipts that's a big number. That's a big number. And while we've seen a lot of clients with gross receipts, sometimes it's hard to get to that 50% threshold in 2020. But in 2021, as you're doing the quarterly analysis, it's a 20% reduction, not a 50% reduction. The other thing I should say right now, again, as you're taking notes, when you're looking at the 2021 quarterly numbers for this gross receipts test, you look at 2019 versus 2021. So in the 2020 year, you look at 19 versus 20 on a quarterly basis to determine if I've hit that 50% reduction. But for 2021, I go back 2 years. I go back to 19. I guess they're calling 19 a base year. So we look at the 19 quarter versus the 21 quarter. And if there's a reduction of 20%, and there's a lot of businesses out there that do have a reduction of 20% versus 2019, if you meet that test in the quarter, you can qualify for this credit. And there's some other miscellaneous stuff on this slide that don't want to focus too much time on. But for instance, under the old rules, if you were non-existent in 19, you weren't eligible for the credit, but now you can claim the 2021 credit for that. So can we go to the next slide? So I kind of rattled off some numbers. Again, you're looking at a quarter over quarter analysis for gross receipts. If I meet that gross receipts test, which is summarized in this second bullet point, you meet the test. The first bullet point on this slide is an important concept, and I think Brian's going to talk more about that. So putting aside the gross receipts test, let's say I don't meet that test. I don't meet the reduction in gross receipts test. So if I don't meet that, then I want to look at my business to see if I had operations that were fully or partially suspended due to COVID-19 in a government shutdown order. And that's where the gray area is. That's where a lot of the thought has to come from the tax advisor and the business owner as you're looking at this. And again, I don't want to steal Brian's thunder. I'll let him get into that later on in the slides. So again, for 2021, we have to have that 50% or less drop in revenue looking at the quarter. Or for 2021, as this slide shows, we have to have a 20% drop in the quarter in revenue. But we also have that same test for 2021 if there's been a disruption in our supply chain, or if there's been if my operations have been fully or partially suspended due to COVID-19, I can possibly qualify for this credit. And again, Brian will go into some more detail with that. Next slide, please. So again, I don't want to beat it to death, but I do want to stress this is an either or test. So either we meet the gross receipts test and we're done and we go claim this credit and we ask for a refund from the IRS, or we have to look at this full or partial shutdown. And again, Brian will talk about more about that later on. Next slide, which I think, Brian, I believe you get to take over.
Yeah, thank you, Brendan. So I think, the next phase of this presentation is really going to focus on this full or partial shutdown due to a government order. You have to have an order that limits commerce, travel, or group meetings due to COVID-19 and basically results in a suspension of the employer's operation of the trade or business. The orders can be from the federal government, but they can also be from a state or local government that has jurisdiction over the business. The governor's order is limiting the operations of a non-essential business. So we had orders that said non-essential businesses must be closed in 2020 during the height of the pandemic. That would be an example of a full shutdown of a non-essential business, and that would make you eligible for the credit. Next slide, please. So an employer that operates an essential business is not considered to have a full or partial suspension if the governmental order allows all of the employer's operations to remain open. So the undercurrent that's going on here is there has to be more than a nominal portion of your business operations need to be suspended due to a government order. So if you're an essential business, let's say you're in construction, you are considered essential. There's been no limitation on your business activities. You were able to do what you were able to do before the pandemic. You're not going to have a full or partial shutdown due to a government order. But if you're a gym that can't have people come in, or you're a restaurant that has restrictions on indoor dining, these are situations which we'll talk about in more detail that would constitute a full or partial shutdown. So next slide, please. So we do have this concept of if you have an essential portion of your business and a non-essential portion of your business, if the non-essential portion of your business is more than a nominal amount of your business operations, you could have a partial shutdown of your business. So, think about an employer who, is an essential business, but has a non-essential business element to it that is material. It's more than a nominal amount. Then you could have a partial suspension, even though you are partly an essential business. If you have to close for a period of time during normal working hours, that can be a partial suspension. So, one of the most common ones that we dealt with is restaurants had to be closed at an earlier hour during the pandemic, and that potentially would result in a partial shutdown. Next slide, please. So one of the things that we see with manufacturers is the inability. There were supply chain issues during COVID. So if you had a full or partial suspension due to the fact that you couldn't obtain critical goods and services that you needed to either to manufacture your product, then you basically could have a full or partial suspension. Again, the focus though is on there has to be a government order that forces your supplier to close and effectively forecloses your ability to get that product from that supplier and the inability to get it from anybody else. Next slide, please. So we're going to go through some examples. These are right out of the regulations. You got an employer that operates an auto parts manufacturing business. The supplier of raw materials must fully suspend its operations due to a government order. And what's key is you're unable to get those raw materials from another alternative supplier. Because of the suspension of the employer's supplier, the employer is not able to perform its operations for a period of time. Under these facts and circumstances, this would be considered a full or partial suspension of your business operations due to supply chain issues. Next slide, please. So this kind of goes back to what we talked about a little bit earlier. So, there has to be more than a nominal effect on your business operations. And I think, the best example is the one we'll come to in the next couple slides, with a restaurant. Restaurants were able to do takeout, for the most part during the pandemic, they were able to do takeout. At some point they were able to do outdoor dining, but the indoor dining, which is more than a nominal portion of their business operations, was suspended. So in that case, because the indoor seating constituted more than a nominal portion of the business operations, it basically resulted in a suspension of the business for purposes of the ERTC. Some things to think about, government orders that basically require you to suspend sort of a key activity in your business is one thing that you look at. If social distancing limits the amount of people that you're able to see or the amount of people that you're able to serve, that may also be another grounds for a full or partial reduction if it's more than a nominal part of your business. Next slide, please. So here's the restaurant example. So in this example, the restaurant had to close on site due to a government order. The governor clearly said that restaurants, bars, and similar establishments cannot do sit-down service. They were able to continue to provide food or beverage on a carry-out, drive-through, or delivery basis. So they could still operate their business to some degree, but because on-site dining is more than a nominal portion of its operations, typically defined as more than 10% of the receipts or more than 10% of the activity, they would be considered partially suspended under the ERTC rules. Next slide, please. So then we'll use the same facts as the previous example, except 2 months later, the restaurant is permitted to offer sit-down service in its outdoor space. So now you've got a restaurant that's doing carry-out and delivery. You've got a restaurant that's serving people in an outdoor space, but they still can't serve people inside, and that's more than a nominal portion of their business operations. So they're still considered suspended for purposes of these rules because they can't provide in-person dining. Next slide, please. So then take this a step further. All right, now you get the following month, the governmental order permits you to offer indoor dining service in addition to outdoor sit down and carry out, but with the caveat that the tables have to be 6 feet apart. And given that the tables have to be 6 feet apart, you cannot fill the restaurant to capacity. So, an example that I use, if you have to be 6 feet apart, maybe you've only got 50 to 75% occupancy in that restaurant. That's more than 10%. So that would have a more than nominal effect on your business, and you'd still be considered partially shut down due to distancing requirements, even though you could effectively do carry out and delivery, outdoor dining, and some indoor dining. Next slide, please. Employers that were forced to reduce their operating hours are also considered to have partially suspended their business operations. So again, this was fairly rampant in the bar and restaurant world because there were different. You could only stay open till 8 or 9 instead of 11, 12, 1, 2 if you're a bar. So that can also result in a partial suspension. Next slide, please. This is an example of it. You have a food processing facility that normally operates 24 hours a day. It's probably 3 8-hour shifts. There's a governmental order in place that requires the employer to shut down for a period of 5 hours to clean the facility. That employer is considered to have a partially suspended business operation due to a government order, and they would be eligible for the credit. Next slide, please. This is more, this example is probably more applicable to multi-state companies. So if you have retail locations in one state and retail locations in another state, one state forces you to shut down, the other doesn't force you to shut down, you can still have a partial suspension of your business operations because some states are requiring a shutdown of your business operations in those states. We've said this a bunch, but yeah, they need, you know, this full or partial shutdown. There has to be a factor that's being reduced more than on a nominal basis. So some examples of things that orders that could reduce your ability customers and have more than a nominal effect, or limiting occupancy to provide for social distancing. That's the restaurant example, where if the tables have to be 6 feet apart, you can't operate at full capacity. If you have a business that used to do walk-ins but can no longer do walk-ins and can only do by appointment, that could be another factor that has more than a nominal effect on your business. In changing the format of the service, for example, if you can't do a buffet or a self-serve, but you can do prepackaged or carry-out, that can have more than a nominal effect on your business if there was a substantial portion of your business that was dedicated to buffets or self-serves. So the full or partial shutdown is probably the more difficult analysis, but back to the decline in gross receipts. In 2020, if you compare a quarter from 2020 to that same quarter in 2019, you're down more than 50% in terms of gross receipts. You qualify for the credit. You don't have to worry about doing a full or partial shutdown analysis. So generally, when we start with this analysis, we start with the gross receipts test because it's easier to document the compliance with that test. You have to get into a little bit more interpretation with the full or partial shutdown, but it's more than 50% from 2020 to 2019. When you get to 2021, you only have to have a 20% reduction. So your gross receipts in 2021 must be less than 80% of your gross receipts in 2019 for you to qualify. Next slide, please. If you're not in existence in 2019, so now you can't compare 2021 to 2019, you can compare 2021 to 2020. There is even an alternative quarters test that you could potentially meet. That's probably outside the scope of what we want to talk about today, but I think the important piece on this slide is to say, okay, if you're not in existence in 2019, you can compare 2021 to 2020. And if you're down more than 20%, you could effectively qualify for the credit in 2021. So we want to talk about this. So this slide assumes that we qualify. We either qualified under the receipts test or we've qualified under the full or partial suspension test. When we're figuring out what wages are allowed for purposes of the credit, it's going to be wages and compensation paid after March 12th, 2020 and before December 31st, 2021. If you're on a full or partial shutdown, it's going to be the wages during the period of that full or partial shutdown. If you're in a period experiencing revenue decline, it's going to be for the amount of the quarter. When you talk about full-time employees, this is more of an issue if you're over 100 full-time employees in 2020, or you're over 500 employees in 2021. Then there's some specific rules that say that you can't be paying people for providing service. That's probably not, this audience may not be in that situation. So if you need more information on that, let us know. But self-employed individuals are not eligible for the employer retention tax credit. Next slide, please. One additional area of complexity is the interaction between the ERC and the PPP. As Brendan said, PPP borrowers originally couldn't claim the ERC credit. Now they can, with the caveat that you cannot claim a credit on wages that you used for PPP forgiveness. So let's say it's March 12th and you're in the second quarter and you've had a greater than 50% receipts reduction in 2020, you're eligible for the ERTC, but you also got a PPP loan in April of that year. So what you're going to have to do is you're going to have to balance, what you can use for ERTC purposes prior to getting the PPP loan and how many weeks you can go into the PPP loan period to basically maximize the ERTC, but still allow you to get full forgiveness for the loan application. So there's definitely, when you've had both the PPP and the ERTC, there's definitely some complexity that goes into that analysis. Next slide, please. So how to claim the ERC? If for 2020, you've obviously filed your payroll tax returns for the 2020 tax period at this point. So you have to go back and file a 941X. If you qualify in multiple quarters, you can just amend your fourth quarter 941. So do a 941X for the fourth quarter. Again, with the caveat that you can't use the same wage dollars for PPP forgiveness in ERTC. In 2021, you have some options. If you knew that you were going to be eligible in the first quarter, you could have reduced your payroll tax deposits in anticipation of having a credit on the payroll tax return and ultimately reducing your payroll tax liability. You could have filed Form 7200 to request an advance on that credit, or you could file on an original 941 for the credit, or if you didn't have enough information available to you at the time to file the 941 original, you can file a 941X. So really the mechanics of this is you claim the ERTC either on an original 941 payroll tax return or on an amended 941 payroll tax return for the most part. Next question, or next slide. Why claim the ERC? Well, I think, this has been an extremely difficult time for small businesses, and, this gives you the ability to get additional cash flow that you can use to help you sort of survive, help you survive the pandemic and help keep you in business while things are ramping back up again. Obviously, the hope is that things are going to start to ramp back up again and we'll be getting to more normalcy, but we probably won't go from 0 to 100 overnight. So this can provide you with some nice additional cash flow to keep you in a good position in your business. So, if you need a couple ways that you can get that cash quicker, effectively reduce your payroll tax deposits on a weekly or biweekly basis. That's additional cash in your pocket at that given point in time. You can also file the Form 7200 if you want to get an advance on your ERTC funds. So there's a couple different ways to sort of, get that cash flow in quicker if you really need it. Next slide. So I think we'll just conclude with, one of our goals, Brendan and I are really committed to the small business community. We want to see small businesses succeed, and this has been a very difficult time. But the PPP and the ERC have allowed some businesses that probably otherwise wouldn't have been able to stay in business to stay in business. And we want to make sure that companies are still receiving the benefit of these programs. So we are offering a complimentary 30-minute consultation if anyone wants to talk about their specific facts and circumstances regarding the credit.
Brian, one final thought, and I don't think we explored enough on the slides, this credit is a refundable credit, meaning, if you think of the math on this credit, that this credit can add up to some real big dollars. And when a credit is refundable, that just means even though the credit reduces our tax down to zero, it actually becomes a negative tax where the government pays us money because it's a refundable credit. So we calculate the credit. We first use that credit to reduce our payroll tax costs, the company costs. And then if the credit is still bigger than the company costs, which a lot of times it is, we have a negative tax where the government pays us money for it. So that's the concept behind a refundable credit. So again, we're just driving home the fact that this is a powerful tool for small businesses, and as a business owner, you should really think about this.
That's important because you may only have a $20,000 payroll tax expense, but you may have eligible for a $40,000 credit. So if it was non-refundable, you could only offset the $20,000.
Right.
Since it's refundable, you can offset the $20,000 and get a $20,000 refund.
Right. It's an amazing credit.
All right, thank you very much, guys. We did have some questions come in. It is a very complex issue, so we do appreciate you offering our members a 30-minute consultation. Truly, that's very much appreciated. So Lisa asks, our nonprofit was operational in 2019, but we had no employees till Q2 of 2020. How would our eligibility be determined?
Well, I guess the first question is, did you have receipts in 2019? So you may not have employees in 2019, but if you had receipts, you could potentially compare 2020 to 2019 on a receipts basis to see if you were eligible. If you didn't have receipts, you may fall into the category of not existing in 2019 and looking at the 2020, comparing 2021 to 2020 to see whether you're eligible in 2021 or not.
Okay. Next question is, I was going to see if she's going to ask it or put any more in the chat. Next question from Jennifer. If we compare Q1 of 2021 to Q1 of 2019 and have the 20% reduction on gross receipts, do we qualify for the ERC for just Q1 of 2021 and then have to compare to Q2 of 2021 to Q1 of 2019 to see if we then qualify for the ERC to get this credit for Q2? Wow.
Close. Close. And I think I understand the question. Brian, correct me if I misspeak. You look at, for Q1 of 2021, you look at Q1 of 19. And you do the comparison. So it sounds like you qualify. Then you hop into Q2. You have to look at Q2 of 19 versus Q2 of 21, do the comparison and see if you qualify. So I believe the specific answer is you got to look at the similar quarter, Q2 versus Q2, 19, 21.
Yeah, so you're eligible. The one wrinkle is if you're talking about 2020 and you were on more than 50%, you were eligible for the credit until your receipts were more than 80% of the prior year. So let's say you were down 60% in Q2 of 2020, but you were down 30% in Q3 of 2020, you'd still be eligible for a Q2 and Q3 because you haven't gotten back to 80% of your 2019 receipts. So that doesn't work as well in 2021 because you're at an 80% threshold anyway. So you have to look at each quarter on an individual basis.
Very complex. And Jennifer, if you want to add to any of that question, please do so in the chat while I'm going to another question. All right, here we are. Doug has a question here. We are a nonprofit funded by the state of Connecticut. We were ordered to shut down for several months at the beginning of the pandemic, but the state actually kept funding our operation at 100% of revenue. We actually were getting more revenue from the state than we normally would have, so we had no decrease in revenue at all. Part of the condition for the funding was that we were not able to lay off any employees. So we were shut down, but we had no revenue decrease. Would we qualify for this credit?
Yeah, I would say the one complexity with nonprofits is if that funding was specifically allocated to wages, reimbursement of wages, you may not be able to double dip there. So if you're getting a reimbursement of your wages, you're probably not going to be able to get an ERC credit as well. If it's not a direct reimbursement for wages, there is the potential for getting an ERC credit based on the fact that you were shut down. As Brendan said, it's an either or test. You either have to have a full or partial shutdown or greater than 50 or greater than 20% receipts drop. So I think I would say you may qualify based on the full or partial shutdown, but I think we need to know more about how that funding works and whether it's a direct reimbursement for payroll.
And, a question that I've heard pop up amongst discussions is that if you are state funded, we know a lot of our nonprofits are state funded, are you allowed to double dip? I mean, that's money that's coming in from the state. Are you allowed to do that? So I've heard that question asked many times as well.
Mm-hmm.
All right, so Jennifer did have another question along with her first one. What will we need to give our payroll provider for them to use when filing our 941 or 941X?
So I'll take this, Brian. We're doing these now. So you've got to document. So you've got to document why you qualify for the credit. So either you have the reduction in revenue test or you have the full or partial shutdown. So you need that documentation in the file. You don't attach it to the return, you just need it in the file. You then need to run the calculation of, so for instance, if we're doing Q1 of 2021, that's a 70% credit times a maximum of $10,000 of wages paid in the quarter. So we need payroll reports. What did I pay my employees? Times 70%. Here's the credit amount. So generally, the payroll providers that I've worked with like to know that we've got the documentation to support the fact that we qualified for this. And then secondly, the calculations to calculate the credit, which then they can layer into the return.
The only thing I would add to that is different payroll companies may require different things. So I think if you're going through this process, you want to consult with your payroll tax company to determine what they specifically want.
Yeah.
Well, you actually just kind of answered another question that came in. Would we go through our accountant or go through our payroll?
Good question. So I'll put a plug in for the accountants, and I would say talk to your accountant. But again, it depends on the payroll service, as Brian said. The payroll services got very good at producing and running reports for the PPP program. I believe they also are doing a good job with the ERTC reporting as well. But it's up to you. Either one can handle it, assuming they're both willing. Go ahead, Brian.
Yeah, the only thing I would add to that is if you're in a position where you're getting a continuing credit, so let's say you're getting a credit in Q1 of 2021 and you expect to get a credit in Q2 of 2021, there may be more benefit to working with your payroll companies and having them code those wages as ERC wages so that they can make the appropriate reduction in your deposits. So reducing your deposits is a way to get the cash quicker than filing a 941 and then waiting for a refund. So, if it's a one-off 2020 amendment, I think either your accounting firm or your payroll firm are well qualified to do it. And I think the cost tends to be very similar. But if you're looking at doing an ongoing credit, you may want to work through your payroll company.
And I would just add a couple of things. One, again, to plug the accountants, if it's a reduction in gross receipts test, that's kind of easy to get to. But if you're looking at these full or partial shutdowns, that can get a little complicated, especially when you get into the gray areas. So then I would recommend talking to your accountant. Or I don't know, Brian mentioned, Brian's a tax attorney, or your tax lawyer. But so I'd stay there. But I agree with Brian. The other thing I want to add is when we're hearing that when you apply for these refunds, they're taking a while. They're taking not weeks, but months for the IRS to process them and issue the checks. So if you go back and file an amended return for Q1, it's going to be a while before you see that cash. So as Brian mentioned, a good strategy is to work with your payroll provider and reduce your payroll tax deposits now ahead of time, so you get the cash now, if you will.
A lot of good information here. We still have a couple more minutes. Does anyone have any additional questions? You can use the chat or the question and answer function at the bottom. As stated earlier, we will be providing this to you after. This has also been recorded. So we do put this on our website under our relaunch page. You can rewatch it if you'd like to at another time, or share it with whomever you'd like to. But we will take some more questions if you have any. But please take advantage of their gracious offering and taking that 30 minutes to meet with them, because everybody's a little specialized and has different questions. And they've certainly stepped to the plate to be willing to help our members. So we really appreciate that. And that I think that you guys can really gain a lot from that, because this is a great program that people should be utilizing.
Yeah, it is.
And I think something I would just add to what Brendan said, it's very important to document your eligibility now. If the IRS comes in and they decide they're going to audit your 941, you don't want to be in a position where you're trying to figure out, well, what did the governor say 2 years ago that forced me to shut down my business? You really want to have those facts and circumstances documented now. And if the IRS comes in, you just hand them a file and you say, here's why we qualify, as opposed to trying to do it on the back end, which can be more difficult.
Great advice. Great advice. Lord knows you don't want to see the IRS come in.
No, you don't. But if you do, it's nice to be able to hand over a file and say, here, this is why we went through the analysis. This is why we qualify.
Really good advice. Good advice. There was a response. This was so helpful. Thank you for your time, from Megan. And there was a few more thank yous. So everybody very much appreciates you guys taking time out of your schedule to do this. Again, we will share this information with all of you that have joined us. So please reach out to Brian or Brendan at any time. They are more than willing to talk with you and help you guys out. If anything else comes down the pike, I'm sure Whittlesey will be right there with us to help us and our members with our needs and our questions. So anything you want to add, Brian or Brendan, before we close?
No, just make sure you think about it. It's the numbers we see are just staggering. They're just, if you do the math in your head, the numbers add up quickly, and it's important that you take advantage of it if you can.
And to that point, rule it in or rule it out. Maybe you're not eligible, but make an informed decision as to whether you're eligible or not, and then move on. But I think you don't want to miss an opportunity that might be there to help your business from a cash flow perspective.
Absolutely. All right, there doesn't seem to be any more questions at this time. Thank you again, guys, for joining us. Thank you, Margie, for helping put this together. I can't believe it's Memorial Day weekend. I think it's going to be a nice weekend coming up. So I wish you all a lot of sunshine, a lot of joy, and stay healthy and stay well, everybody. Have a great day. As you know, the sun always shines in Middlesex County. Thanks, guys. Have a great day.
Thank you. Bye-bye.